This is TreppWire Week in Review for the week ending June 23rd, 2023. I'm Haley Keene with Trepp, a data, modeling, and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Hendry, Head of CRE and Advisory Services. This week, U.S. stocks hit a wall after several weeks of strong gains and the S&P 500 entering bull market territory. Interest rates seem to play a role in this week's sell-off. Fed Chair Powell indicated in congressional testimony that more interest rate hikes would be necessary to tame inflation. In addition, the Bank of England surprised analysts with a 50 basis point rate hike on Thursday, and central banks in Switzerland and Norway also raised rates. The news wasn't all bad, as we saw housing starts come in sharply above estimates. Manus, was this week's bumpiness a function of the market coming too far too fast, or do you think there's more to it?
Well, I think the market was very evenly divided between the two precincts, if you will. On the one hand, coming into this week, many market watchers were saying the market had come too far too fast. If you noticed, the percentage of bulls versus bears was extremely tilted to the bullish side. That's usually a contrarian indicator and is indicative of the fact that the market may have come too far too fast. So there was a lot of evidence of that. I think we had gotten into this AI euphoria, which had pushed up stock prices dramatically for firms like NVIDIA and AMD and others. People had jumped on that AI bandwagon very quickly. So yes, I think we were overly exuberant, but you can't discount the fact that interest rates and inflation remain front and center for most analysts. Earlier in the week, Fed Chair Powell, while speaking before Congress, said that more rate hikes would likely be necessary. In fact, he threw out the number of 50 basis points as a possible peak from now. That got people's attention. We also saw, as you mentioned in your open, the market was quite stunned today that the Bank of England raised rates by 50 basis points, and central banks in Switzerland and Norway also hiked rates. The UK is an interesting story. Their inflation is still above 7%, and they will have to probably stay very aggressive going forward to fight that. So to answer your question at the open, I think that we were very, very evenly balanced between going too far too fast, along with concerns about inflation and interest rates.
Yeah, it's really interesting, Manus. If you read into Powell's comments today, he's quoted as saying, "We move very quickly at the beginning." Not quote, but I would say understatement. We've gradually slowed down. This is just a continuation of that. He does try to add some perspective, though, by just saying that after 10 consecutive increases, taking a pause really just gives them more time to stretch out that time for making decisions going forward. I think all of us lose sight of the fact, maybe, that when they started raising, that initial uptick was significant, but none of us would have assumed that they would have raised consecutively at the pace in which they did. And I mentioned this last week on the pod, like the full effects haven't been felt. But at the same time, if you look at some of the other numbers that they've been tracking with unemployment and other things, like you're not seeing the cool off that I think they want to see. So I think this is going to continue to be a topic of discussion. I think it's maybe likely that we see another rate increase or two before the end of the year. It's just really a weird place because it's unprecedented the pace at which they raise rates. We see all of the potential signs for distress in CRE. We've talked at length on the podcast with office, with some of these other property sectors starting to show cracks, but nothing is like completely fallen off a cliff at this point. Like everything is still functioning at some level of normalcy, greatly reduced from the peaks of post-COVID when everyone was flush with cash, but it's still performing at a level that's not raising real concern. The bank crisis, 3 banks go under. There's not 20 that have gone under. So I think we're kind of in this gray area where they're hoping everything stays intact and cools off. But if it doesn't, I think we're still going to see some increase from them on the rate side. There are a couple of other topics this week. U.S. home prices posted biggest year-over-year decline, biggest decline in more than 11 years last month, primarily due to the rising interest rates. Median existing home sales prices fell 3.1% in May. And so that was the largest drop since December of 2011. So when you hear those things, Biggest year-over-year decline in more than 11 years. Median home price fall 3.1%, the largest drop since 2011. It just tells you how strong of a bull run we've been on since we're sitting here in 2023 and we're having to go back to 2011. So, I think from that perspective, even the housing market, you would think with interest rates where they are, prices would come down significantly. And we're talking about a 3%, decline at the median. It's not that significant.
I think the biggest surprise, to echo your point, of the last several months has been the fact that the bank failures have been so contained, right? You threw out the number of 20 before, that it was 3 and not 20. I'm shocked. I'm shocked that it's not 20. I'm shocked it's not 40 or 50. When you combine the commercial real estate exposure with the uninsured deposits, I thought that was a tinderbox waiting to be lit. The fact that we haven't, I think, is a really positive sign, and it shows that the markets are functioning, and I think it's a wonderful thing. But I have to say that's my biggest surprise. In terms of the heat that the economy is generating, there's just a lot of pressure, I think, on Powell to at least keep talking the hawkish talk. We saw housing starts this week, which was significantly above expectations. We know that the jobs number remains near historic lows. The JOLTS numbers remain really high. The first-time unemployment claims week after week remain fairly close to historic lows. And when you put that together, that's a lot of heat that's being generated. And you use the word, I think, confusion, or it's a dichotomy, or whatever you want to call it. But I think you're absolutely right. On the one hand, you feel like the ship is taking on water in the commercial real estate space and in the tech layoffs. And on the other hand, you think it's running at 85 miles an hour in the unemployment side and other areas. So, and housing, in terms of housing starts. So it's very hard to make the argument with a lot of conviction that the cup is either half full or half empty.
We're experiencing one of those market dynamics, as you said, it's a little bit confused, and you hope the good prevails. You hope that no more banks go under, things just organically cool off through the Fed actions. And, we're talking here in the next year or so of Feds maybe cutting rates and the market being, stimulated to pick back up. So it's an interesting time.
I wanted to pivot to something else, which talks about market conditions. This has to do with new issue pricing. People have reacted to this quite positively in the past in terms of benchmarking where their positions might be if they're debt holders, or where loan rates might be for new securitizations and so forth. We did see a deal price in the last couple of days. This was an $825 million CMBS deal. About 40 or 50% of the loans in the pool were contributed by either Barclays or B of A. This was a conduit deal. Weighted average debt service coverage ratio just under 2. LTV weighted average 52. Weighted average interest rate 6.6%. Those are the portfolio level statistics. On the spread side, and this is 10-year, by the way. I know a lot of people have been talking about 5-year conduit issuance, and there's some of that in the market right now. The AAA for this particular issue, which priced, I think yesterday, 150 over the curve, which was 17 basis points tighter than the last AAA conduit deal to price. AA minus 250 over the curve, which was exactly in line with the previous conduit to price. And the A minus class 400 over the curve, which was compared to 390 in the last conduit. This data comes from Commercial Real Estate Direct, our sister company, which does a great job of tracking this particular data. So if you're looking at single A paper, what we're talking about now is essentially 400 basis points over the, let's call it the 10-year treasury. Yes, it's adjusted for the SOFR curve, but you're talking about right now a rate of about 775 all in for single A minus debt. Pivoting to individual loans here, and I'll throw these out just to give people a sense. I'm looking at the top 15 loans that went into this deal, and I wanted to give people a sense of what lending rates are for various assets. I thought this was a very positive sign. The biggest asset in this particular deal is the Fashion Valley Mall. We all know that malls have been beleaguered, both with defaults and also reputationally over time. The fact that this mall was able to get refinanced is terrific. This particular loan had a rate of 573, DSCR of 315, and an LTV of about 32. So if you're under levered, which this certainly was, this particular asset with a 32 LTV, you can still get loan rates in the 5 handle, right? And that's out there for good performing stuff. The highest loan rate among the top 15 loans, I thought this was interesting, was the Oxmoor Center, which is another loan. This is in Louisville, Kentucky, 812. So you could see that there's about a 250 basis point difference in loan rate between the highest loan rate and the lowest loan rate. The lowest loan rate, DSCR 315, occupancy 94, LTV 32. Why is the Oxmoor so much higher in rate? Well, DSCR 150, LTV 59, occupancy still 94%. So I'm really putting this out there both for those who might be, would-be borrowers to get a sense of what the market is operating at right now, but also for people that are new to the industry, people who want to know what is the premium that people have to pay in terms of higher rates for the same type of asset with higher and lower leverage. And when you look at the Fashion Valley Mall on the one end and the Oxmoor Center on the other, it gives newbies a chance to understand how that risk reward premium can change for like assets. So a little bit of what's happening in the market. And the big takeaway for me, Lonnie, the market's still functioning. We're going to see 5 or 6 deals come this month, some 5 years, some 10 years, some SASB. Lending still going on. This particular pool had a little bit of everything: office, suburban office, medical office, retail. So things are chugging along, maybe not 85 miles an hour, but certainly 45.
Yeah, it's definitely, and it's great to see. I mean, we've been having a lot of folks on the sidelines and deals not getting done. And it's nice to see some new issuance come online. It's nice to see the pipeline, even though it's reduced, come online with some, new deals. And so I think you have to be optimistic about those signs of what we're seeing right now. It's not as good as what we want it to be, but to your point, it's still functioning. Deals are getting done. People are still ambitious and making decisions and bets on, upside. And it's interesting just to see the dynamics between those loan rates and the different risk parameters in the marketplace. And so, you can say you can negotiate price or terms. And I think we're starting to see that play out a little bit here.
Yeah, I mean, I don't know if you recall seeing it before, but I don't recall seeing 8s in the past. This is the first time I remember seeing an 8 handle on a new issue loan, but maybe they've been out there and I've been just kind of not paying attention.
There's a couple of portfolio deals short term that were above that, which when you look at, you think it's an error at first, and then you look through the docs and it's not. But yeah, an 8 is a little bit more than what we're used to seeing. But I would assume at this point, the borrower felt like they were getting something that they probably otherwise didn't think they were going to get financing on. And so you do what you got to do.
So we talked about housing and residential real estate at the start, but let's turn it over to commercial and dig into some multifamily.
Yeah, we had a couple stories this week, none of them particularly positive, some a little bit surprising. The surprising one came from our CMBS data. The $196 million loan backed by a property called The Air in the Upper West Side of Manhattan was headed to special servicing. The property also has some street level retail. Occupancy fell from 97% in 2018 to 70% in 2020, which is not particularly surprising. We were going through COVID. It has since rebounded to 97%, but DSCR remains below 1.0x, which is a little bit shocking to me, I have to say, because New York has been such a robust housing market coming from the middle of COVID on. To see something that's got a lot of people's attention, I have to say, we saw this buzzing on Twitter and we saw a lot of the press pick this up as a story. We've seen some multifamily defaults in San Francisco, but nothing like this. So this was a very unusual story and something we'll be watching going forward. This is a 2013 loan, so you would have thought that this would have had some serious price appreciation over the last 10 years, and yet it's with a special servicer. The loan is slated to mature in November. Story number 2, this comes from old friend Albie Gallen of Crane, Chicago. Invesco has sold the Northwater Apartments. They're at 340 East North Water Street. The buyer is Crescent Heights. Sale price $173 million. Why did this get my attention? Two reasons. One, it's the most anybody's paid for Chicago multifamily in 2 years. So that's a positive sign. The negative sign is for the seller, Invesco, it represents a 28% decline in value since 2016. So not ideal there, but probably consistent with what we're seeing in terms of value drops for multifamily in cities that have quality of life issues. And then lastly, I would call it raucous hearing in New York City, the New York City Housing Board agreed to a 3% rate hike for landlords this year. Tenant advocates were hoping for a decrease. I think they were quite disappointed and they let their voices be heard at that meeting. 3%, probably half the rate of inflation when you talk about labor increases and supply increases. What's the fallout from landlords in New York getting something which is perhaps half the rate of inflation?
Yeah, I think it's a real challenge, and I think it's a compounding challenge. It's obviously a challenge today, but it's going to continue to be even more challenging into the future. And if you're a lender and you have a large exposure, if you're an owner with large exposure, it really changes the underlying fundamentals of your investment thesis. And I think that's something that has to be considered. We talked about, I think it was Signature Bank that, or was it First Republic that had the large exposure to, the rent-controlled multifamily in New York. But there's just not a buyer for that. It's the market has said we're going to be limited on what we can do. If our increases can't offset the cost to turn units, then we're not going to turn those units. And so it's a really interesting dynamic. And it's not just New York. We're seeing this play out across many large cities in the US and not just for multifamily. In fact, I read some stuff last couple of weeks in Oregon where on commercial tenants, if you increase the rents above a certain amount and they don't want to sign the renewal, you actually have to pay to help move them to a new location as the landlord. And so in my opinion, it's an infringement on property rights. It's creating an imbalance in terms of supply and demand, which negatively impacts the folks that actually need that lower rent, affordable housing component. I think we need to, build more units. We need to relax zoning and other restrictions so that developers and entrepreneurs that are willing to risk their capital can actually help people that need affordable quality places to live. And I think building is the way to get there.
Yeah, I think it does that without a doubt. It's certainly the supply demand equation is well documented. It's been well researched. Analysts have been talking about this for a long time. But I'd also think that, I hate to say it, but it comes out of the hide of the tenant too, in terms of maintenance of the physical stock of the property. Right, that landlords, if they can only have that 3% increase, are not going to put money in to repaint a hallway, replace plumbing, improve HVAC or anything else. And it's a double whammy, right? Lack of supply combined with degrading physical conditions is not a recipe for helping lift people out of poverty.
So let's turn to our office segment. We have a lot of stories that we saw this week, but let's start with some of the news we've seen around valuations.
Two stories that got a lot of attention on Friday afternoon when June remittance data came in. The first one was for listeners who've been following this story for a couple of months. You'll know what I'm talking about. Also for CMBS investors, the asset I'm talking about. This is the CXP office portfolio loan. A $1.7 billion note. The backer is Columbia Property Trust, which is an arm of PIMCO. A couple months ago, they came in and said they are not going to support the asset any longer. They were not going to look to extend the loan. There was seen to be negative equity, or at least the erasure of equity for the property owner. Twitter was the top tenant in 2 of the 7 properties backing the loan. We all know that Twitter has been subletting properties and not paying rent. This month, the headline was that the collateral, which was valued at $2.3 billion in 2022, was lowered this month to $1.6 billion. So some of the debt is now underwater. This is a negative twist for bondholders of 2 2022 CMBS deals. So that was valuation 1. Valuation 2, not quite as dire, but still concerning nonetheless. This comes out of Denver. The value of the Wells Fargo Center in that town has been cut. It remains modestly above the loan balance. The property is a 1.2 million square foot office. It backs a single asset 2019 deal. The loan balance is 277 million. This month, the value was lowered from 475 million, which was a 2019 number, to 287 million, which is the 2022 number. So a couple of negative valuations there. Pivoting to other stories in the office market, in Rosemont, Illinois, a suburb of Chicago, the $114 million Riverway loan has been sent to special servicing. This particular property lost Central States Pension Fund as a tenant. It backs a 2016 and 2017 CMBS loan. DSCR has been under 1.0x since 2020. In California, the eBay North First Commons loan missed its maturity date in June. It's been in special servicing since April. The borrower now wants to talk about an extensive loan modification that would push the maturity date out to 2026. The hair on this particular loan is that eBay is the sole tenant. They've indicated that they don't have use for the office. Their lease goes to 2029, but they can terminate in 2026, which probably made this loan unrefinanceable, and hence the desire for the long-term lease extension. In San Francisco, you never want to see this particular term used in a headline. This comes from Laura Waxman of the San Francisco Business Times. 180 Howard Street in Frisco is under contract as, and I'll use quotes here, market shows signs of capitulation. 180 Howard is a 250,000 square foot office. It had been the headquarters of the state bar for 30 years. The price is expected to be about $250 per square foot. That would represent a sale price of $62 million. Earlier this year, the property was listed for $85 million or $400 a square foot. So we're talking about a 60 or 40% price reduction over the course of 6 months or so. The same article notes that Clarion Partners is putting up 60 Spear Street up for sale. They're looking to sell the property in the $200 per square foot range. This property traded for almost $700 a square foot in 2014, 107 million. So San Francisco, I hate to pile on there, but when you see that word capitulation, I guess it could be good or bad, right? You never want to see this. It talks about a market in distress, but on the positive side, it does usually mean that a bottom is near.
Yeah, I think you're starting to get some clarity of what that bottoming out looks like in terms of pricing. But if you just look at this objectively, almost $700 a square foot to $250 is just incredible in a couple of years. And so, you hope that this is contained, but the reality is I think there's definitely going to be some more pain before it gets better.
I never like to go through a podcast without some positive stories. And we actually have 3 or 4 today on the positive side for offices. So I'll run through those one after another. In New York, this comes from Cranes New York's Eddie Small. Clayton Dubilier Rice is tripling their square footage in Midtown Manhattan. They're taking about 150,000 square feet of space at 550 Madison. That will be up from 50,000 square feet at the Seagram's building. So a nice story there. From the Commercial Observer's Aaron Elstein, Citadel, the hedge fund run by Ken Griffin, they are said to be in talks to take 400,000 square feet at 280 Park, which would be a nice boost for that particular asset. It does back a big single asset CMBS loan. That particular part of Manhattan could come under stress. JP Morgan is in the process of opening up a new headquarters. It looks to be about 60 or 70% done. The framing is going up. The skeleton is done. Once that opens, I think JP Morgan will probably downsize in many nearby offices. And Citadel taking 400,000 square feet at 280 Park would be a shot in the arm for that part of the market. And a positive story out of California. This comes from Jordana Rothberg of Commercial Property Executive. Praylock Real Estate has acquired a 250,000 square foot office in Santa Clara. They're paying $182 million for a fully occupied property. The seller is a partnership between CBRE and CalSTRS. Those two firms bought the building for $162 million in 2017. So we're talking about $20 million in appreciation, about 7.5% over the course of 6 years. The property itself is fully occupied by Applied Materials. So in California, not all stories are negative. Here, a sale price at a $20 million premium for CalSTRS and CBRE over the 2017 purchase price. So a couple of good stories there. Happy to report them.
On the Citadel stuff, Manis, did you hear their intern class this year? They're paying them $5,000 a week as an intern. I think that's down in the Miami office. So not a bad gig if you can get it, if you're a 21-year-old, 22-year-old, college student.
You got to bite your tongue, Lonnie. We're going to have some of our permanent employees here like pretend to be interns down in Miami. It does harken back to one of my favorite movies, The Internship, with Vince Vaughn and Owen Wilson. One of my favorites. Two guys my age reinventing themselves.
That was a good one when they talk about the Instagram and I think Vince Vaughn's saying, yeah, create this app that takes photos and post them. And the guy's like, oh, you mean like Instagram? Yeah, I feel myself in that world as well. Things are passing me by.
As long as I don't have to, they had the two of them in what looked to be a twin-sized bed, in the Google dorms. I do want my own bed. I do like my personal space. I did have one more story on the office front. This is from Commercial Observer, Celia Young. This one caught my eye because of the name of the tenant. A nonprofit organization, Child Mind Institute, which is probably something I also have in common with guys like Owen Wilson and Vince Vaughn, a Child Mind. They're moving their offices in New York and doubling their footprint at the same time. They are relocating from 445 Park, where they have 50,000 square feet, to 85,000 square feet at 825 3rd, which is a Durst building. So I think we had equal amounts of positive and negative this week with office, which makes it a good week. Yeah, very quickly, we'll go through these. I'll start with a good story since we're on a roll there. The $35 million Rolling Valley Mall. This is in Burke, Virginia. It paid off ahead of its 2023 maturity date. It just goes to show that not all retail stories are negative ones. We already mentioned in that new pricing discussion at the top of the hour that two malls got refinancing in the new CMBS conduit deal was done, the one in San Diego and the one in Louisville, Kentucky. So a couple of positive stories in that realm. In addition, in the Bay Area, this is from George Avalos of the Bay Area News, Burlington Coat Factory and Sprouts are opening up two new stores in the same complex in San Jose. This is at 375 North Capitol Avenue. In total, the two firms will be taking up about 80,000 square feet. So several positive stories on the retail side. On the mixed green side, this comes from Commercial Real Estate Direct. The owners of the Poughkeepsie Galleria, which I think is Pyramid, if I'm not mistaken, have announced that they have extended their loan once again. This is a $131 million CMBS loan. The collateral contains about 700,000 square feet. It has been delinquent since 2021. The loan was not paid off at its balloon date that same year. And it is part of CMBX 6. DSCR has been under 1.0x, occupancy under 60. Yet this is a familiar refrain. The owners here trying to lean in and keep this property, and they have fought for an extension. So lots of positive stories there. Quickly through the negative ones. Pecan Land Mall. This is in Louisiana. The value of the collateral was cut substantially from 131 million down to 43. There's now substantial negative equity in the asset. The borrower has hinted that a deed in lieu is coming. In North Carolina, in Pineville, the $150 million Carolina Place loan was not paid off at its balloon date this month. It backs a big CMBX 7 loan. In New York, the Sangertown Square Mall loan, which was extended 3 years ago, has been sent back to special servicing. That's a $53 million loan. And in Chicago, 1 North Street which is street level retail. TJ Maxx is a tenant. Burlington is a tenant. That particular loan has headed back to special servicing and is now 30 days delinquent. So a couple negative stories to go with some nice ones in the retail segment.
Yeah, you covered a lot of information there, Manus. I think a couple of takeaways on the large mall property. Collateral was valued at $237 million in 2011, lowered down to about $69 million in 2020. So really interesting that they're continuing to fight for that, but it's great to see. And then it's a good feel-good story for the two new tenants in the Bay Area and San Jose, Burlington Coat Factory and Sprouts Farmers Market. They've kind of found a niche there in some of those repositioning of go dark big boxes where they've come in and subdivided those and made for really nice locations for those types of tenants. And those two in particular, I've seen them move into some backfill dark space across the US, and they seem to do really, really well once they get in those centers. So hopefully for these two tenants, it's a nice addition to that retail center.
I'll throw in one more because you brought up tenants that are kind of in that middle ground between the department store sized entities and the smaller shopping center inline guys. When we talk about TJ Maxx and guys like that. One more positive story. This comes from Steve Rzuski of the Orlando Business Journal. It was of a piece of our last story. Orlando Square, which is an 185,000 square foot shopping center in Orlando, of course. It has been sold for $25 million. Why did that catch my attention? It's up from $17 million in 2019. So about over the course of 4 years, we've seen $8 million, almost 50% appreciation for this asset. And it fits that mold of the types of places that have done better than the department store malls. Right? In this case, it's Ross Dress for Less, Ollie's Bargain Outlet, a gym, a Chase Bank, and then among the food places, Chipotle. Those are one more positive story to throw out there.
Thanks for covering all those stories, Manus. We've had a lot of property sector news this week on the pod. I wanted to hit one industrial story very quickly, and then we'll transition over to the life science. According to Commercial Property Executive, Adidas has renewed a lease for almost 600,000 square foot of industrial space in Indianapolis. They utilize the property at 8677 Logo Athletic Court in Indianapolis, Indiana, which is currently being used as a finishing facility for their athletic and footwear. And so it's really great to see, on the heels of what we talked about last week related to industrial, a nice sizable 600,000 square foot renewal taking place in, what you would consider to be a secondary market in Indianapolis.
All right. We also saw a few stories in life science this week.
Yeah, this was really interesting. Life science has been right up there with industrial in terms of the property type that could do no bad and do no wrong, that type of thing. And there was one positive headline this week, but there were a few cracks to be seen, and I'm interested to get Alani's take on it. Let's start with a positive. This comes from Commercial Observer, Greg Cornfield. Ally Properties, along with TPG Real Estate Partners and Anchorline Partners, has acquired a 5-property portfolio of lab and life science properties. The portfolio in total covers 425,000 square feet. If I remember correctly, these properties are in Cambridge and in that corridor outside of Boston that is life science centric. They are paying $365 million for this particular portfolio. So a nice premium price for that asset. That is the green shoot of the week. There are two concerning stories here, and we'll go after them one by one. The first one comes from Ron Ludy of the San Francisco Business Times. Interven Biosciences has announced it is canceling a 10-year lease for a newly constructed building in South San Francisco. The article says there's been a wave of real estate decisions by life science companies to conserve cash and pull back. The lease had been for 5 stories, 145,000 square feet at 499 Forbes Boulevard, and it was meant to be a big expansion. That is now off the table. Also from the San Francisco Business Times, this one from Sarah Clearman, biotech company Lonza Group has scrapped plans to sign a new lease in Emeryville. The firm was in talks to take 150,000 square feet at 1650 65th Street. That is now off the table. And so we're starting to see some cracks in that what had been an incredibly strong market for life science. In that Sarah Clearman piece, she also points out that Alexandria Real Estate has pulled out of a 600,000 square foot life science campus that they were developing in the Bay Area as well. So the first of what might be, I don't know, an inflection point, Lonnie, in the life science space.
Yeah, so we talked a couple of weeks ago about maybe hitting that with the industrial market, and I think we're going to start seeing that. We are with these stories in life science. We may start seeing it in some data center stuff too. You know, the reality is the real estate market is cyclical for all property types, and these property types have had a really, significant uptick in pricing, rental rates, absorption, lack of vacancy, et cetera. And you just get to a point to where things get overbuilt and people start to conserve capital. And I think, these are some of the downstream impacts that, as Powell's talking about, maybe not seeing the full effects of the rate increases. Like these might be some of those downstream implications where, the banks don't fail, but some of these proprietors decide to conserve cash, not take on the expansion, not do the new construction project. Things start to stall out a little bit. So, life science has been one of the darling asset classes. Kind of came on the scene out of nowhere, but I don't know if we're at an inflection point yet. But I'm not surprised that we're starting to see some people maybe, choose a more conservative path versus just continuing to lean in.
Yeah, I think we have two things going on here. One is COVID had so heightened the expectations for the asset class. The idea that you could have things like Moderna come out and be so impactful so fast kind of got people's animal spirits really going for life science. I think some of that has now pivoted to AI. And I think the reality that has hit people is for every one Moderna, there's 200 people that would like to be Moderna or firms that would like to be Moderna that flame out. I think that realization is part of it. But I think you can't discount the fact that in San Francisco, probably a lot of these funders had their money at Silicon Valley Bank. They saw an endless supply of capital being available. There was nobody there to tap the brakes. And there's probably been a reckoning due to the higher rates and due to Silicon Valley, which says the venture capitalists are saying to the innovators, it's time to start harnessing cash and making smarter decisions. The teller window is going to be closed for the next 6 months.
I was up in Boston last week and they've got a pretty large life science, kind of biotech science footprint there. And I think I saw 2 or 3 different Moderna conferences that were going on at different hotels up there. So, it's not like the users of these buildings have suddenly gone away, but to your point, maybe some of the capital that was funding some of the real estate expansion has definitely tightened down.
Okay, so a quick programming note from our end. Tomorrow, which if you're listening on Friday, that means today, we are hosting our Market Pulse webinar. You still probably have a few hours to sign up, so email podcast@trepp.com if you'd like to register for that. And also on Friday, June 23rd, we will be releasing the names of our future CRE leaders. So this is an awards program that we do in December and in May to congratulate graduates who are interested in commercial real estate or CRE finance. And we have a very promising class that we will be sharing tomorrow. So stay tuned for that. And turning to shout outs, Joe G said he just started listening to the podcast after a strong recommendation from one of his colleagues. He said it's been a godsend and it's a tremendous way for him to stay abreast of everything going on in the real estate and the banking sectors. Manis, Bob P sent you a shout out. I don't know if you saw this one, but he said in reference to your comment a few weeks ago about bankers in wingtips, he wonders if any of our young listeners even know what those are.
The sad thing is I can't even remember my wingtip reference anymore. I mean, I was vague recollection talking about wingtips, but I don't even remember the the context, but thank you, Bob, for the reach out. And Haley, you'll have to remind me what that was off.
I don't know either, but I may have had to Google that myself. So Bob might be right.
I was always more of a loafer guy than a wingtip guy. And the older I got, the more I wanted something that I could just slip my foot into effortlessly. If I could, wear Merrells without getting scorned at the office or at like weddings or other social events, I would. You know what a Merrill is?
No.
It's the stuff that the kids used to wear to school that they slip on. They have a little tag in the back, no laces in and out. It's I'm like an 8-year-old boy in a not 8-year-old body.
So Dan M., who was always a huge podcast fan, we saw him in New York recently. Bob W. is a listener who wanted some more positive news discussed. He knows it's out there, so we had a few positive office stories this week, and we'll make sure to work some of those in. William W. reached out to let us know that he and many of his associates enjoy the podcast. Patrick L., who we actually met at the NAOP California event, reached out for some content. Ben P. said, thanks so much. He listens every week. Iman J. said he loves the podcast. It's been incredibly helpful to understand the real estate landscape, and I believe Lonnie is working with him. Derek T. listened to the podcast and congratulated us on our 200th episode. We also found out from Susie S. that our own Sridhar, his nephew, actually is an avid listener. So shout out to Vinay V., who learned about Trepp from Sridhar. Sridhar said probably even when Vinay was very young as a child. Micah L. is a big fan of the show, been listening to all of the episodes for the past 6 months. Dave D. said he is currently working on breaking into the CRE industry and finds the podcast extremely helpful. So I'm glad we can play a part in your education there. Richard S. said he's a big Trepp fan. He said he even forged new business relationships based on reaching out to some of the guests that we've had on the show. Martin K. loves the podcast. He said he can't top our listener who listens while swimming, but he does listen while running on the elliptical on Friday mornings. AJJ said the weekly podcast is fantastic. He listens on the sidelines of his son's football practice. And Chris R. was actually interested in some transcripts of some of our past episodes. We don't currently offer those, but if that's something that you all would be interested in, feel free to shoot us a note. It may be something we look into in the future. And then we got a lot of requests for the mid-year magazine with CRE Direct, Wes J, Nareej A, Madur D, Kate A, Avik M, Chris M, Jeff O. And then Omar E on Twitter offered us some of his feedback after we said that we felt market participants were a little complacent at last week's CRE event. He said he would describe the sentiment as more of a contained concern. He said many participants acknowledged the challenges ahead, but still have overall faith in the system.
I had a chance to talk to Omar at length at the conference, and great guy, very enthusiastic guy. And it's always terrific to meet some of our listeners in person and get their perspective and have mature dialogue on what is going on in the market. And I think that was a good way of putting it. I was looking for a better word last week than complacent. It wasn't like people were whistling past graveyards, but they weren't panicked either. So maybe that cautious concern is probably a better description of the sentiment last week than maybe my choice of words.
I think the complacent word got some people thinking, because I actually got an email today from a loyal listener, Mark M, in Dallas, friend of the show, and he emailed in saying that based on our conversation last week, that he's also seeing, a lackluster, was what he used, lackluster attitude, and he thinks it's really kind of a byproduct of people that have been in the market for some time and maybe understand that there's a transition. And if they lived through the great financial crisis in 07, 08, 09, they know that they sold very few deals in 09, and it wasn't until 2010 and 2011 that things started picking up. So at this point, they're kind of in that lull phase, but they know that things are going to pick back up. So he's optimistic and thinks that, we'll see an increase in activity the latter part of this year.
So before we close, Manus, you reminded me a few days ago that Dead & Company was back in New York, so all of the Deadheads were very excited. And that got me thinking that I don't think we spoke about that Fed Chair Jerome Powell was actually spotted at a Dead & Company show, so I think he's a self-proclaimed deadhead. So that had me thinking, what do you guys think? We have a lot of loyal listeners. We love all of the engagement. Do you think we can call them Trepp heads, or is that strictly for the deadhead group?
Is that what we should we label the people that are, have been there since the beginning and go through every episode with us, the Trepp heads? I don't know. You guys can all come back to us on Twitter or through email. Let us know if you think that's a sign of endearment or not. I got to say, it was a remarkable sign of, I don't know if we call it loyalty or interest, or it was very humbling, whatever you want to call it, when Haley told me at 7:30 last Friday morning that after 8 hours, we had almost 3,000 listeners, which is an enormous vote of confidence for me. And just, as I said, tremendously humbling. But I personally, I like the Trepp head name. I don't know about you guys. I was never a deadhead, although I would go see any live music, and if given the chance, I would go see them one or two more times. So
Well, we have a sports radio show here in Texas, and they have their loyal listeners are called like the P1s or whatever. It's like there's maybe we come up with some sort of a Trepp moniker, and maybe we can get some cool T-shirts made or something like that. But yeah, it's always exciting and humbling when you see people listening and tuning in as soon as Haley gets this thing posted on Thursday nights. And, I think it comes across in how we approach each week. We want to bring relevant topical information to the listeners, but just know all of you that listen and reach out via email, it really provides motivation for us just to keep trying to put on a really good show every week for everybody. So we definitely appreciate the engagement, the interaction at the CREFC conference and every other event that we do. And, look forward to continuing to grow this even beyond what it is at this point.
And with that, we'll close. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or a comment, send an email to podcast@trepp.com and subscribe to the TreppWire Podcast with your favorite provider. Thank you for listening, and stay well.
all right.